Hello, everybody. Please type yes into the chat box if you can hear us. All right, we're looking good. Thank you for joining our learning series, Navigating New Roads. Today's webinar program, Revenue Recognition for Nonprofits, will be presented by Withum's Jim Mulroy and Peggy Gallagher. Before we begin, I have a few housekeeping notes. Materials for today's presentation can be found in the toolbar located on the right hand of your screen. At the bottom of the toolbar, you will see a question box. All questions pertaining to the webinar content should be asked there. We will do our best to address them. Be sure to answer all of the polling questions to ensure that you receive CBE credits for today's session. And if you find yourself encountering any issues responding to the polls, make sure that you're out of full screen mode. Once the webinar is over, there will be a pop-up asking you to complete a survey of today's webinar. Please take a moment to complete it. It's our way of being able to provide you with the best and most relevant programs possible. And finally, to raise the stakes a little bit, at the end of each session of our Navigating New Roads learning series, we will have a trivia question for you to answer. The attendee who answers the most trivia questions correctly at the end of the series will receive a special prize from our Withum team. And with that, I'm going to turn it over to Jim.
Thanks so much, Ashley, and good afternoon, everybody. So glad you could join us today. Just a reminder that the presentation today represents the personal views of myself and Peggy Gallagher, and not necessarily the views of Withum. So just wanted to mention that. And with that, we can go on to today's agenda. What we're going to talk about is the background and scope of Accounting Standards Update 2018-08, which deals with contributions received and contributions made. We're going to help you distinguish between contribution and exchange transactions. And we're also going to help you distinguish between conditional and unconditional contributions. And then Peggy's going to take over and walk us through a Topic 606 refresher, revenues from contracts with customers. And yes, not-for-profits can have customers. We're going to talk a bit about the documentation of your decision process. And then hopefully we'll have some time for some questions at the end. So with that, let's get started. So on the next slide, you'll see that the main reason that this ASU came out was really to address two primary diversities of practice that not-for-profits were incurring in the treatment of this standard. One dealt with characterizing grants and similar contracts with government agencies as exchangers or contributions. And what this really got to was primarily related to government expense reimbursement contracts. There were some not-for-profits that were treating government expense reimbursement contracts as exchange transactions, while other not-for-profits were treating these contracts as contributions. So there was diversity of practice. There was also diversity of practice when it came to distinguishing between conditional and unconditional contributions. There was some language in the old standard that caused some confusion. And what that language said was that a conditional promise or contribution is considered unconditional if the possibility that the condition will not be met is remote. So what was happening is not-for-profits were really getting involved in making a probability analysis as to whether or not conditions identified in a grant award would be met or not. For instance, if they received an award to provide 10,000 meals to the homeless, and they typically provided 20,000 meals to the homeless, you could say, well, of course we're going to meet that restriction and that condition. It's not really a condition at all. And they would recognize the revenue right away. And what this standard makes clear is that really you should not be using a probability analysis. You should not recognize the revenue until that condition is met. Another reason that this standard became required was because of Topic 606 that Peggy's going to be talking about. That key decision of is a transaction an exchange transaction or a contribution is really important when it comes to Topic 606, because Topic 606 deals primarily just with exchange transactions. So if your first decision, if a transaction is a contribution or exchange is wrong, that may take you down the wrong accounting model. So that's kind of how we got here with this standard. So on the next slide, you'll see that this standard applies to all entities, both not-for-profits and business entities that receive or make contributions. It excludes transfers of assets from the government to business entities. And it applies to both contributions received by a recipient and contributions made by a resource provider. So it's somewhat interesting that while we're focusing today on revenue recognition, what you need to realize is that if you're a not-for-profit that also makes grants to others, you'll be going through the same process that we'll be talking about in terms of when you recognize your grant expense. So I think that's important to realize. Now, there is no need for you to call up your funding sources and make sure that you're treating the transaction the same way that they are, but in theory, you should be using the same accounting model. Also, the term used in the financial statements to label revenue is not a factor for determining whether an agreement is within the scope of the guidance. So, what this means is it doesn't matter if on your financial statements you call your revenue grants or contracts or awards or donations. The key issue is what is the substance of the transaction and what accounting model do you treat it under? So again, the first big decision you need to make is contribution or exchange. So a contribution is an unconditional transfer of cash or other assets in a voluntary, non-reciprocal transfer by another entity. So the key elements here is that it's unconditional and it's non-reciprocal. I am getting something for nothing. Now contrast that with an exchange transaction, which is a reciprocal transfer in which each party receives and sacrifices something of approximately commensurate value. So I'm giving you something and I'm getting something of equal value in return. And the question that you may ask is, why does it matter? And the answer is that there could be a significant difference in the timing of revenue recognition, depending upon whether or not you identify the transaction as a contribution or an exchange. Contributions, typically revenue is recognized when the contribution is made or received. And if you characterize the transaction as an exchange transaction, that can get you into topic 606 or lease accounting or some other accounting model for recognizing revenue. So really this decision that you make is really critical. On the next slide, we give you some key indicators of exchange versus contribution. So on the left side of the page there, you'll see under exchange, again, this key element is that commensurate value is transferred. The resource provider is receiving a direct benefit. The resource provider is getting something for the funds provided to you. The intent of the parties is to exchange resources of commensurate value. You contrast that with a contribution. In a contribution, the resource provider may only be getting indirect benefits, or perhaps the public benefits, but there is no direct benefits. So important to realize those, those indicators. So again, the next slide, we highlight this issue of commensurate value. Who benefits, and we talk about the resource provider. And what's interesting is what the standard does is it kind of tells us what commensurate value is not, to try to clarify some of the misgivings that some not-for-profits had in the past. So, what it tells us is that the resource provider is not synonymous with the general public, even a governmental entity. If a resource provider receives value indirectly by providing a societal benefit, this would be considered a non-reciprocal, which means contribution transaction. So what this is driving at, for instance, is again, a government contract provided to a not-for-profit to provide meals to the homeless. So the individuals receiving the meals are getting a direct benefit. The government is not getting a direct benefit. So that would be treated as a contribution under this new standard. And for some of us, that may be an alien concept, the thought that government can make contributions. Also, furthering a resource provider's mission or positive sentiment does not constitute commensurate value received. So if if I'm a healthcare foundation and I provide you with an award to, I don't know, enroll people in healthcare or promote healthcare, while that's furthering my mission, as a healthcare foundation, I am not getting a direct benefit from that. So similarly, that would also be, in effect, a contribution because there is no exchange of commensurate value. And then finally, the type of resource provider should not override the substance of the transaction. Again, this concept that the government, under certain circumstances, those government awards could be treated as contributions. So the way I like to think about this is that you have transactions that would be treated under the contribution model, and then you may have transactions that would be treated under the exchange model, which gets you into 606 or lease accounting or perhaps some other standards. So on the next slide, there's another clarification that the standard brought about, and it spoke about specified third parties. And what this is really talking about is transactions like Medicare or Medicaid. So if I go to the hospital for care at a hospital and I'm a Medicare recipient, there's a relationship, there's an exchange transaction between myself and the hospital. I'm going there, they're providing me with care, they are billing me. But because I'm a Medicare recipient, Medicare is also making payments to the hospital. And the question is, what is the nature of those payments that Medicare is making? And what this standard is clarifying is that, in effect, those payments are really part of the existing exchange transaction between myself and the hospital. In effect, Medicare is piggybacking on that existing relationship. So it's not a separate contribution transaction. It's, in effect, part of this existing exchange transaction between myself and the hospital. And the similar theory holds true for Pell Grants and tuition assistance and perhaps short-term affordable housing voucher payments. In effect, those are likely not contributions, but they're part of an existing exchange transaction. So that's important to remember. So on the next slide, the second key decision you need to make is if you decide that you have a contribution, the next question is this contribution conditional or unconditional? So what is a conditional contribution? A conditional contribution is a contribution that has a donor-imposed condition. So for a donor-imposed condition to exist, you need one or more barriers that must be overcome, and you need to have a right of return to the contributor for assets transferred, or a right of release of the promisor from its obligations to transfer assets. If you fail to do what you say you're going to do, if you fail to overcome the barrier, you need to pay back the funds to the resource provider. And realize that that's an end. You need both of these. You need the barrier and the right of return release. That's important. If you only have one, you're in the unconditional bucket. And again, the question that you may ask is, why does it matter? And again, it's a timing issue. Conditional contributions are not recognized as revenue until the condition is substantially met. So depending upon how you characterize these transactions, there could be a big difference in your financial reporting. So on the next slide, we talk about indicators that a barrier may exist. So inclusion of a measurable performance-weighted barrier or other measurable barrier. So the key is that it's measurable. So to the extent that an award includes a specified level of service, you must provide 200 meals, must provide 400 visits. It's measurable. That's an indicator that the agreement includes a barrier. The agreement identifies a number of units of output or a specific outcome. For instance, I'll give you a capital grant to expand your facility by 5,000 square feet. It's very specific and it's very measurable. That indicates a barrier. Or an identified event occurs, like a matching requirement. I'll give you $1 for every dollar you raise. When you raise $1, that's the barrier, and then you've earned the other dollar. The extent to which a stipulation limits discretion by the recipient on the conduct of an activity. So to the extent there's a requirement to incur qualifying allowable expenses, and that kind of gets to the heart of the government grant issue. A lot of government grants, are very specific in terms of what you can spend the money on, and more importantly, the how you spend the money. The agreement may require you to hire specific individuals to perform the program, or it may identify specific protocols that must be adhered to. So when the agreement gets into the how you must conduct the activity, that's an indicator that a barrier may exist. And then finally, the extent to which a stipulation is related to the purpose of the agreement. So, to the extent that the agreement includes administrative tasks or trivial stipulations, those really are not typically barriers. If you need to provide an expense report or narrative program report, those are really unrelated to what you need to do and typically are not deemed to be barriers. So the next slide, I just want to talk about budgets a little bit, because this was another source of confusion that we still continue to see today. So the existence of a budget and a requirement for adherence to that budget within certain deviation limits by itself does not indicate a barrier. many times not-for-profits provide a foundation or the resource provider with a budget in terms of how they plan to spend the funds and what they need to do to conduct the activity. So those budgets are really just kind of a guidepost for what the not-for-profit, how the not-for-profit is going to conduct the activity. So a budget alone is not going to be a barrier. But that differs from the concept of incurring qualifying expenses where entitlement to the funds is dependent upon compliance with a litany of cost principles and other requirements, often driven by public policy. Again, in the aggregate, typically those cost principles really kind of control how the activity is performed. So those typically would indicate a barrier. So again, in the instance of government contracts, many times expense reimbursement contracts are going to probably wind up being treated as a conditional contribution because it is likely that the government may not be getting a direct benefit from that contract. Other individuals, other populations are getting the benefit. But nonetheless, the contract typically will include, cost policies, an Office of Management budget circular policies. You need to incur those qualifying expenses. So, our estimation is that those types of grants are going to be treated as conditional contributions, and as you incur the qualifying expenses, you would recognize revenue under those grants. So the next slide just talks about, the right of return release, and it gives you some samples there. So the agreement does not need to use the actual terms, right of return, right of release, but it just needs to convey the fact that if you don't do what you're supposed to do, you need to repay money that you've received, or you're going to forego the ability to receive future payments on the award. It is critical that that language be directly in the agreement, or that language be in another document referenced by the agreement. So the words matter. So it's important that the documentation reflect what your decision-making process is. On the next slide, we run across this quite a bit where foundations often include this standard language. The foundation may modify, suspend, or discontinue any payment of grant funds, or terminate this agreement if the foundation is not reasonably satisfied with the organization's progress on the project. And the question often comes up, is this a barrier? Is this language sufficient to constitute a barrier? And we believe the answer is no. This is really protective language for the foundation, for bad players perhaps, but it does not rise to the level of a barrier. So on the next slide, I think what we'll do is just go through some examples. And I think these examples will kind of help solidify some of the concepts that we've been talking about. So example one, contribution versus exchange. Not-for-profit A is a large research university with a cancer research center. It receives funds from a pharma company to finance the cost of a clinical trial. The pharma company dictates the number of participants to test, dosages, frequency, and requires a detailed report of test outcomes. The rights to the results of the study belong to the pharma company. So the question is this a contribution or exchange? And this is actually our first polling question, Ashley.
Polling question number 1. Is this a contribution or exchange transaction? Contribution, exchange, not sure. Make sure to get your votes in order to get your CPE. And we're going to close it out in just a few seconds. And we're closing out.
Great. So most of you did get it right. This is in effect an exchange transaction. So good job. So the reason it's an exchange transaction is because the results of the trial have commercial value to the pharmacy company. The pharma company is receiving direct commensurate value. They retain the rights to the study. So that's deemed to be commensurate value to the resource provider. So example 2, contribution versus exchange. A local government provides funding to a not-for-profit to perform a research study on the benefits of a longer school year. The not-for-profit is required to plan the study, perform the research, and submit the research to the local government. The local government retains all rights to the study. Is this a contribution or an exchange? And on the next slide, you'll see this is also an exchange transaction. Again, because those study rights are retained by the local government, it's determined by the not-for-profit that direct commensurate value was exchanged. And then example 3, contribution versus exchange. Federal government made an award to a university. Office of Management and Budget rules and regulations must be followed. Qualified expenses must be incurred to be entitled to the assets. Unspent money is forfeited or returned, so right of return release exists. University retains the rights to the findings and has permission to publish the findings. So again, is this a contribution or an exchange? So this is a contribution. The federal government does not receive direct commensurate value because the university retains all the rights to the research and findings. So perhaps the public, the general public, receives the benefits, but the federal government did not receive direct commensurate benefit. So this would likely be treated as a contribution. Example 4, conditional versus unconditional contribution. So we have a private foundation gift. A not-for-profit receives a grant of $400,000 to provide specific career training to at least 8,000 disabled veterans during the next year, with minimums for each quarter of $2,000 per quarter. There's a right of release. The foundation will only provide $100,000 per quarter if the not-for-profit demonstrated it trained the 2,000 disabled veterans during the quarter. Is this conditional or unconditional? And on the next slide, you'll see this is conditional. All right, we have the right of release that exists in the grant. We need the right of release and a barrier to have conditional. We spoke about how level of service, the specific level of service, constitutes a barrier. So in this case, we have to provide 2,000 career training per quarter. So this is definitely a conditional contribution, and we would recognize the $100,000 after we provide training to 2,000 veterans per quarter. You would not recognize the entire $400,000 up front because it's conditional. And being conditional, you only recognize revenue when the condition is substantially met. Example 5, conditional versus unconditional. We have a research grant. Not-for-profit A is a public charity that works with gluten-related allergies. Not-for-profit A receives a $100,000 grant from a corporate foundation to perform research. The right of return exists in the grant agreement. There's a general budget that must be followed. Any significant deviations in spending must be approved. And we need to submit a cost report at the grant closeout. Is this conditional or unconditional? And this is actually our second polling question, Ashley.
Polling question number 2. Is this contribution conditional or unconditional? All right, and just another 2 seconds. And we're closing out.
So unconditional is correct. So most of you did get it right. There is a right of return, but we need right of return and a barrier. That general budget and those reporting requirements are not sufficient to be determined to be a barrier. They're really just kind of guideposts as to how we're going to conduct the activity. So in this particular transaction, it would likely be deemed to be unconditional. So the next slide is kind of just a chart that kind of is a visualization of this decision-making process that we've been talking about. So in the upper left-hand corner in that blue circle there, you'll see that the transaction in which each party directly receives commensurate value? If the answer is yes, that takes you to the right. It's a reciprocal transaction or exchange transaction, and that gets us into topic 606, which Peggy will talk about, or perhaps other guidance. If the answer is no on the left-hand side, that takes you down, and therefore it's a non-reciprocal transaction. And that means that we apply the contribution model, if you will. And then the question is, are those conditions present? Do we have the right of return release? And do we have a barrier? The answer is yes, it's conditional, and you recognize revenue when that condition is substantially met. The answer is no, that takes you over to whether or not you've got restrictions, and need to determine whether or not you've got a restriction on your net asset classes. So I just thought I'd include that to kind of just give you a good visualization of the process that we're talking about. The next slide just talked about some financial statement considerations. As you know, we've always had this simultaneous release option. So to the extent that a not-for-profit receives funding with restrictions, and to the extent that restriction is met in the same period, you could record those transactions directly in the without donor restrictions column. So I just wanted to mention this again because you just may want to take a look at this to see if you've made that election and whether or not, as you apply this new standard, that election is going to change anything. In particular, as it relates to perhaps your government grants. You may have been identifying government grants as exchange transactions, and now they're going to be treated as contributions, and it could kind of change the presentation of your financial statement. So we do suggest that you kind of take a look at that and evaluate, if you don't have that policy, if you should consider adopting it. The next slide just talks about disclosures for recipients and resource providers. There really is no new disclosures. For recipients, you need to talk about, for conditional promises to give, you need to talk about the total amount of amounts promised, a description and amount for each group of promises having similar characteristics. Resource providers are also required to provide information about unconditional promises to give. Those always existed. Again, the one change may be, again, to the extent that you had government grants that, in the past you treated as exchange transactions, and now you're treating them as contributions, you may actually need to disclose the unexpended portions of government grants that have been awarded. So that's something also to think about. And the next slide would just give you some example disclosures for those conditional contributions and conditional grants and contracts, just to give you kind of a roadmap as to what those disclosures may look like. The next slide is really kind of a revenue recognition footnote. And what I like about this slide is it kind of, uses the language that we've been talking about in the standard, talks about reciprocal and non-reciprocal, exchange and contribution. I think it may kind of solidify what we've been talking about today. You may need to update your footnotes again in terms of government grants. You may have identified government grants as exchange transactions. They may actually be treated as contributions. So you may need to modify your footnotes in that area. But do take a look at that. I think you may find that helpful. And then the effective date on the next slide. For recipients, it's pretty much effective December 31st, 2019. If you're a junior end, it would be June 30th, 2020. If you're a resource provider, it's effective 12/31/20 year ends, or if you're a junior end, it'll be June 30th, 2021. So what about not-for-profits that are both recipients and grant makers? You've got two different implementation dates there. So if you both receive grants and make grants, you may want to evaluate your financial statements. You may get some funny accounting. So what you may want to consider doing is early implementing the resource provider effective date to sync up with the recipient effective date. You may want to just take a look at that to make sure that you don't get some strange results on your financial statements. And again, as I mentioned, this standard relates both to grant recipients and grant makers. If you are a grant maker, I do encourage you to look at your grant award documentation in the light of this new standard. Does your language include a barrier? Does it include a right of return release? Does it sync up with what you're actually doing in your financial statements? Certainly, you can modify the language in your awards to achieve the objective that you want to achieve, but you probably should look at your language to make sure that you don't have any unintended consequences when it comes time for your audit. So I think with that, I'll pass it on to Peg.
Thank you, Jim. Hello, everybody. Thank you again for joining us. It's nice to have you here with us, and happy Friday. As Jim queued up, now we're going to speak a little bit about revenue recognition under the new guidance. It's known as ASC 606. And if you recall the decision tree that Jim spoke about, there will be instances where you may find yourself here. So I'm going to hit the high points for you. Hopefully you'll get some nuggets that you haven't heard before. And here's one that is really very, very recent news with respect to the effective dates. You're probably wondering, why is she putting this up here? I know when it's effective. Well, just a few days ago, the FASB released ASU 2020-05, which extended the implementation date for ASC 606 by 1 year. And that is applicable to entities that have not yet released financial statements already incorporating ASC 606. So if that is you, you may decide to take advantage of this extension. If you feel you are too far along or you're already into it, which many of our for-profit clients have concluded, then by all means, you may go ahead and release financial statements, including ASC 606. And P.S., the same ASU had a little bit more good news. It also extended the effective date of the new lease accounting standard by 1 year. And as a quick refresher, that's ASC 842, and that is basically the standard that asks all entities to bring all leases, including what we now know as operating leases, on our balance sheet. So this ASU also extended that by 1 year. So some good news for your Friday. All right, so it's always good to start with some foundational basics, and there are some common themes in ASC 606, which I have found, and I hope you will find, to be very, very helpful in understanding some of the decisions and outcomes. First of all, we need to keep in mind that this is principles-based guidance. Up until a few years ago, our traditional GAAP, our traditional ASUs, here in the United States, obviously, were written in a very, very rule-based fashion. Once talk began arising, I'm going back a number of years now, of potential convergence with international accounting standards, our guidance became more principles-based, which means there's less hard and fast rules and there's more disclosure to almost compensate so that the users and the readers of your financial statements can look at these expanded disclosures and get insight into your key judgments and decisions. A very important concept in 606 is called the control concept. I'm on the second bullet point here. And that's looking at it from the customer's point of view and thinking about when revenue should be recognized. When was the control of those promised goods or those promised services transferred over to a customer? So the control concept is very foundational. The amount of revenue recognized will equal the total consideration that an entity expects to be entitled to. It's kind of common sense. There are expanded disclosures, as I indicated before. And for the clients that we've implemented 606 for already, I can tell you that even if there is no dollar impact to the financial statements because of ASC 606, there is certainly an impact on the disclosures, quantity. There's far more of them, and they can be lengthier. The name of the standard is revenue from contracts with customers, but please don't take that word contract too literally. What they really mean is what you think it means, agreements, right? So many of us, when we hear the word contract, we think of a formally executed agreement. Sometimes there's lawyers involved. A contract in ASC 606 world could be a purchase order, okay? So don't let that word throw you off. And the most important foundational concept of all is these 5 steps, which we're going to go through in a moment, must be followed in a logical fashion. And that is very, very different from how we think about revenue in fact, how we think of many accounting areas today. And what I mean by that is you start at step one, let's say, and you only think about the concepts pertinent to step one. And only when step one is satisfied, which happens to be, is there a contract, would you move on to step two. And the same thing applies there. You will only think about the concepts that are pertinent and relevant to that step. As I said a moment earlier, today we kind of throw everything out on the table, which is fine, and we think of it all at once. But with 606, you will see, I know I have when I've assisted clients in applying this, that sometimes we're really talking about a step two matter, and then the amount of revenue and when we're going to be recognizing it creeps in. And we really kind of almost have to train ourselves to push that aside. We're only thinking about step two, defining what the performance obligations are. So think of them as silos, if you will. There are some scoping things to keep in mind for 606. Jim mentioned leasing as a possibility earlier. And so those scoping considerations are here on the slide. Jim did a fantastic job about talking about non-reciprocal or non-exchange transactions, but there's some other types of revenue streams here on the slide that are scoped out of ASC 606, and you will continue to follow other present GAAP for those. So just keep those in mind. And some examples here of common ASC 606 revenue sources for not-for-profits. I'm sure many of you were thinking about these as Jim was speaking. This is just some of them. They're listed here on the slide. And keep in mind that there may be instances in some of these revenue streams where we will actually have to bifurcate the amount of revenue between the contribution portion and the exchange portion. Okay, so obviously everything I'm talking about right now in this segment is going to be for the exchange portion if you would have to bifurcate. So just remember to keep that in mind as well. And now it's time for our third polling question. Take it away, Ashley.
Polling question number 3. How far along is your organization in its ASC 606 implementation? Get those votes in.
No.
Alrighty, we're going to close that in just a few seconds. Okay, and we are closing out.
All right, and what do the results look like, Ashley?
So it's looking like we have about halfway done. They're at 33%. And then next is have not started at 24, complete at 27, and not applicable to my organization at 16. So the most votes came in at about halfway done.
Yeah, that's fantastic. And for those of you who haven't started it yet, keep in mind that new ASU, you may just find strategically it's preferable for you to just kick the can down the road for another year. And for those of you that have it in process, you might just want to continue going forward, or you might want to put it on ice for a little bit. There's really no universally right or wrong answer there. It's what suits you, and in particular, the users of your financial statements. So certainly keep that in mind, as I know you always do. All right, so we're going to go into the 5 steps now. Again, we're going to really just touch on them very, very briefly. And let's start with step 1. So step 1 is identifying the contract. I will tell you that this is typically not a very difficult step. It's usually pretty easy to meet. There are certain criteria. So I know I spoke to you about principles-based standards before, but in this particular step, the FASB did give us certain criteria to meet, and we've given them to you in an appendix at the end of this presentation. So we won't be going over that appendix today, but it's there for your future use. So take a look at those criteria. But again, typically identifying the contract, ensuring that an actual contract, an actual agreement exists is typically not a hardship. And do keep in mind that it doesn't necessarily have to be in writing, right? And we're talking about accounting now. We're not talking about the law or legalities. Obviously, for that, you would probably want to have a contract in writing. But for accounting purposes, this kind of a contract for ASC 606 does not necessarily have to be in writing. We're going to jump to step 2 at this point, identifying the performance obligations. And this is probably the single most critical step in the 5-step process under ASC 606. And it's also probably one of the more theoretical kind of steps. So I'm going to hopefully break this down for you and make it a little bit more understandable. The key concept here is identifying the performance obligations. And performance obligations are the unit of account, if you will, for accounting for revenues. And the remaining steps all flow out of this. And in some cases, there may be just one performance obligation. In other cases, there may be more than one. So on the left-hand side here, I've given you the accounting definition of what a performance obligation here. And no surprise, the most important word in this definition is that it is something that is distinct. So let's dive in and talk about what that power word distinct means in an accounting sense. So distinct has 2 pieces. The first piece is here on this slide. And the idea behind this first piece is that the customer may benefit from it on its own. So if you think about an ASC contract that you have, the contract may discuss several different promises that are made to the customer. And again, you're always going to be looking at this from the customer's point of view, right? So there may be some promises that the customer attaches great value to that perhaps for you as an organization, they're rather trivial. So you always got to look at it from the customer's point of view. And so when you have that list of promises assembled, then apply the 2 pieces of this definition of distinct to it. And the first piece is, think about it. May the customer benefit from it on its own. And I will tell you that this first part of the definition of distinct usually isn't terribly difficult or terribly challenging. As it says on the slide, benefiting from its own can be in the sense of, can it be used? Can it be consumed? If it's a good, can it be sold for an amount greater than scrap value? Or can the customer utilize it together with other readily available resources? Can they go out in the marketplace, for example, and buy that other part very easily? You know, was something already provided to them in the context of your contract that together with this secondary good, it will be distinct and the customer can benefit from it on its own. So that's the first of the 2 pieces of what distinct means. The second part is usually the more challenging one, and it's known as, is it distinct in the context of the contract? And this is where looking at it from the customer's point of view is really key. In the context of that contract, from how the customer would approach it and think about it, does this promise rise to the level of being distinct in the context of the contract? Again, there may be differing points of view between you as the organization and your customer. So let's just dig in a little bit more into that idea of what is distinct in the context of the contract. The FASB did give us 3 factors to think about. I've listed them in those last 3 bullet points here on the slide. There's a lot of judgment here in this part of step 2, you guys. And this, as I've said several times already, this is the part that we really wrestle with. So it's important to spend a sufficient amount of time on this step and to really kick the tires on it well. But keep those factors in mind. And again, keep in mind looking at it from the customer's point of view. Would the customer view it to be distinct in the context of the contract? So some insights here for how to tackle step 2. As I said before, the best place to start is really by listing all promises. Depending on how complex and lengthy the contract or the agreement is, you could have a very long list. Or if it is just a very short or an abbreviated agreement, you may have a very, very short list. But do start by listing all of them and then apply that definition of distinct that we just went through to each of them. We do have a little bit of a practical expedient here that can help us greatly. I know in the real world, as I've worked on 606 applications, this has come in handy very often. We are allowed to disregard any promises that are immaterial in the context of the contract. And that last part is really key here. It's got to be immaterial in the context of the contract. So at the contract level, not at the entire organization's level, or not at the level of all similar contracts, but in the context of that particular contract, if it is immaterial, that promise, we can disregard it and we don't need to consider it any further. So this is just a recap of what I've been talking about, how to apply step 2, identify those promises from the customer's perspective, apply that definition of distinct as we spoke about. Do not think about when to recognize the revenue or for how much. Those are later steps. You can disregard anything that's immaterial in the context of that contract. And then finally, you'll conclude on step 2 and you can go on to step 3. So here's an example for you. How many performance obligations could there be in this example? And our example here is a trade association that charges its members annual membership dues. And in return for that, the members get access to an online database, a subscription to a monthly publication, and discounts on future training and educational opportunities. The trade association needs to consider whether each of those things are a performance obligation by referencing that definition of distinct. And I would say, just looking at the facts and circumstances here on this slide, that most likely each of these 3 things would rise to the level of being a separate performance obligation. However, I don't know whether any of these are immaterial in the context of the contract. For example, maybe the access to the online database is really immaterial and I might be able to disregard it. So there's an example for you. Here's another one. How many performance obligations do you think are in this example? In this case, we have a professional membership organization. It presents conferences 2 times a year, and it offers 3 different types of conference sponsorship that include various combinations of reserved seating at a premier table, opportunities to deliver a keynote address, different sizes of exhibit space, and online recognition as a sponsor on its website for 90 days. So the organization should, again, take each of these promises, roll them through that definition of distinct, and conclude as to whether or not each of these things would rise to the level of a distinct performance obligation. And it doesn't need to think about when the revenue would be recognized, what method it would be recognized under. It will consider those things later. Here's a slide that comes in handy. Sometimes it's easier just to know what usually isn't a performance obligation. And there's some common examples here on this slide. Customer options are obviously marketing offers, so those are definitely not a performance obligation. Any activities that an entity may undertake to fulfill a contract that aren't actually transferring goods or services to the customer are not a performance obligation. Again, if you look at those from the perspective of the customer doesn't know that you're performing administrative tasks in the background. Pre-production activities and shipping and handling activities, those are all things that are usually not performance obligations. Let's jump into step 3, determine the transaction price. So we refer to the total transaction price using that abbreviation TTP as having 2 pieces. It consists of fixed consideration and variable consideration. And the accounting treatment under ASC 606 of variable consideration is the part where we're seeing most of the changes in applications of ASC 606. I've given you some examples here of what the total transaction price will both include and exclude, so do take a look at those for your reference. Let's talk a little bit about variable consideration. It's important to remember that it can come in the form of either positive amounts that will increase the transaction price or negative amounts that could decrease the transaction price. So if I offer my customer a rebate or a discount, obviously that's an example of negative variable consideration. But if it's possible for me to earn a bonus, then that is an example of positive variable consideration. This concept of variable consideration is going to, in many cases, lead to earlier revenue recognition because in prior GAAP, we weren't really allowed to consider it. So here's a little recipe for you of how to estimate variable consideration. Similar to the performance obligations, you need to take a look at that contract or agreement and identify all elements of it. And don't forget to think about implicit variable consideration. A great example of that is if the organization has a pattern or history of discounts or rebates that might not be spelled out in the agreement, but do keep them in mind as a potential source of variable consideration. Then do a little bit of a dive, evaluate the facts and circumstances. GAAP provides two different methods that can be used for estimating variable consideration. So keep that in mind if you do end up going down this path. The other thing to keep in mind for variable consideration is a concept of a constraint. GAAP requires us to reduce our best estimate down to what we believe is most probable to occur. That's called the constraint because it tends to have the effect of lowering those positive elements of variable consideration. And lastly, if the contract spans several accounting periods, because the variable consideration is an estimate, that estimate should be considered to see if it needs to be updated prospectively going forward. Here's an example right here of variable consideration, but in the interest of time, I'm just going to keep going, but there's a good example for you that I think will illustrate the concepts nicely. And we're going to get into step 4, allocating the transaction price. So step 4, step 3, and step 2 are probably the 3 most critical steps in our 5-step process, with step 2 being the most critical, as I said earlier. But let's talk a little bit about allocating that transaction price. Obviously, if you only have one performance obligation, which is the case in many instances, this step doesn't apply and you can just skip over it. If you have more than one and there is a fixed price, you need to start thinking about allocating it. And the big concept here is that you need to allocate it based on the relative standalone selling prices. An easy example here is that if you walk into a car dealership to buy a new car, the dealer tends to throw in other things, right, as a sweetener to get you to buy that new car. But on the back end, in theory, the dealer is going to have to allocate the total transaction price, the price you agree on with the dealer, to each of those packages that they threw in addition to the basic purchase price of the car. GAAP gives us 3 different methods for estimating that standalone selling price. They're here on this slide. Do keep them in mind if you find that this step applies to you. The other thing to remember too is that this step is in theory occurring on day 1 of the contract. So any information that is known or knowable on day 1 of the contract is what you should consider. Any information that arose subsequently, you might not be able to consider. Here are some examples of how to allocate under step 4. And lastly, if you've satisfied step 4, we get to go to the fun part, the last step, step 5, which is when you recognize the revenue. Revenue is obviously recognized along the basis of performance obligations. Those are your units of account, as I indicated earlier. So it's quite possible that depending on the performance obligations that were identified, you may have a different revenue recognition method for each one. So if you have 2 performance obligations, for example, it's possible that one of them may have its revenue recognized at a certain point in time, where the other one may have its revenue recognized over time. Recognizing revenue over time has some guidelines. There are 3 of them presented here on the slide that the standard gave us. I think most of these are pretty common sense. I haven't seen too much difficulty in practice applying and identifying this part. Here's an example for recognizing revenue. Again, in the interest of time, I'm just going to skip through this, but it's here for your reference. And that takes us up to our last polling question. Back to you, Ashley.
Polling question 4. Which step of ASC 606 will be the most challenging for you? Closing out in just 2 seconds. All right, and we're closed. And it
And
looks
what's our
like
top?
we have step 2 coming in with the most votes, identifying performance obligations.
Not a
And step
surprise.
4.
I
Yes.
agree, but there's a good point in there that depending on your fact patterns, sometimes it's the other steps that can be problematic at all. And in many, many cases, none of them are problematic. So thanks for your responses. On this slide, I just wanted to point out that there's a lot of content on ASC 606 that we could spend time looking into. So just please put these on your radar and don't forget about them. I mentioned the expanded disclosure requirements in the beginning. The standard does require some sort of retrospective adoption. It's usually not painful, but it can be. Licensing revenue has some special treatment, so if you're in that world, keep that in mind. And also there may be some impact on your systems, right? On your general ledger or financial reporting. Sales commission plans in particular can be a little sticky. And we talked about the most 3 difficult steps. And now I'll turn it back to Jim.
Thank you, Peg. So yeah, just a final word on documentation. It's really critical that you document your decision-making process on all these issues that we've raised. We do find that sometimes not-for-profits don't do a great job at documenting how they got to the answers that they did. So, for smaller not-for-profits, it could be as easy as putting the documentation on the face of the actual award. It could be that you can use your CRM or your development software to put your conclusions for each of your major awards. Withum has some Excel-based tools for Topic 606 and contributions. If you're interested in those, please let us know. Also, again, the words matter. It's important that the elements of your decision are coming from how the documents are written, that you're not making decisions based upon data that's not in the documents themselves. So do take a look at that. And with that, Ashley, I think you've got a trivia question.
Yes, we do. All righty. Our trivia question is, what is the rarest M&M color? And this trivia question was submitted by Jim Mulroy.
Because I love M&Ms.
I was going to ask that.
Peanut butter is my favorite.
Ooh. Now we're getting into the M&Ms that are filled with stuff. They have the hazelnut flavors too. All right, and we're going to close it out in just 2 seconds. Okay, we're closing it out. Jim, you want to take it away with the right answer? We got blue coming in hot at 39%.
I believe the correct answer is actually brown.
It is.
There you go. So Ashley, we have time for questions?
Yeah, we have a few minutes. Anybody who wants to stay on the line, I know the webinar is technically over in a minute, but we do have time for anybody who would like to stick around.
All right, I do see one question in the chat box that I can answer, and it says, when you speak about the housing rent voucher payments, are you referring to just the tenant who has a voucher? What about a direct HAP payment from HUD for an entire building? So the issue I spoke about piggybacking on an existing exchange transaction, that probably relates more to a Section 8 subsidy, whereby there is an existing lease arrangement between the tenant and the property owner. So there's an existing lease arrangement, and then HUD is paying an additional subsidy for that individual tenant on that lease. So that's kind of the example that I was actually referring to. In terms of a HAP payment from HUD for an entire building, that's actually a different scenario because an entire building is not necessarily a specified individual. So I think that may get you to a different answer. HUD is not getting a direct benefit, so it probably gets you to contribution accounting. It's probably conditional contribution based upon you need to provide the apartments for the tenants over a certain period of time. So I don't really think that your revenue recognition is going to change from what you're probably doing now. it's really just a documentation issue. That's all that I see. Ashley, you want to wind us up?
All right, so if there's no more questions, we thank you guys for attending today. There is handouts in the handout portion of your toolbar. There will be a follow-up email with a copy of the recording of the webinar today and the handout if you do need it or would like to refer to it later. And we thank you for attending again. Everybody stay safe, and we will see you next time.
Thanks, everybody.